Good morning and welcome. If you've ever read our Finance 2027 or Full Court Press blogs,
You already know we don't do surface level.
and today we are diving deep into one of the most persistent and frustrating traps in finance. The whole investing versus gambling dichotomy. We're using some cutting-edge research from Lexicon Labs as our map.
Our mission today is really to interrogate the language behind our financial and legal systems. We want to figure out why, after centuries of sophisticated markets, we still use these words, investing, speculation, gambling, so incorrectly.
It leads to bad policy, bad thinking.
Exactly.
Okay, let's unpack this a bit. This debate, it's not new at all, is it? We hear modern politicians, President Obama, telling us, don't gamble, invest.
Right, sounds simple, moral even.
But the confusion and kind of the moral panic around it is literally as old as America itself.
It is.
We're tracing this all the way back to 1792, to Alexander Hamilton, who was watching the early stock market.
And he observed that certain characters continued to sport with the market. He actually used the term unprincipled gamblers.
Unprincipled gamblers.
Yeah.
That's a powerful phrase.
It's critical context.
Yeah.
Hamilton wasn't just reacting to, prices going up and down. He was reacting to a deeply held moral belief.
Right.
The belief that treating without the public good in mind was just morally corrupt. He felt he had to demand a line of separation between honest men and knaves.
So that moral dimension, that blending of what's legal and what's virtuous, has tainted this whole conversation from day one.
From the very beginning. And today, we see that debate flare up constantly in two specific places.
The stock market, of course, which goes right back to Hamilton's time.
And the second one, which is growing so fast, is prediction markets. Highly scrutinized.
But here is where the Lexicon Labs research comes in with a really surprising argument.
It is. The central argument is this, asking, is this investing or is this gambling in either of those markets? It's just fundamentally the wrong question.
Wait, I have to stop you there. The wrong question. That goes against everything we hear in the media, even from some academics.
It's a conceptual mistake.
So you're saying when someone buys a highly volatile meme stock, they aren't gambling? Because that's what the average person would call it.
And it's fascinating to understand why that intuitive connection is wrong. The problem is that gambling is fundamentally a legal term.
A term of prohibition.
Exactly. It's tied to specific state gaming laws. But we use it loosely, moralistically, in everyday language, and that just muddies the waters completely.
So we conflate a legal issue with a moral one.
We do. Legally, the stock market is a regulated venue. It's for trading interests in, cash flow generating assets.
So if I buy a stock, even if I treat it like a casino chip, the law still sees me as participating in regulated speculation, not an illegal lottery.
Precisely. Gambling, legally, usually requires a lack of economic purpose. It's about creating risk that doesn't serve any public interest, and it's often in an unlicensed venue. The stock market just doesn't meet that definition.
Okay, so to fix our mental model here, the research says we have to stop using two buckets, investing and gambling.
And start using three. It's crucial. Investing, speculation, and gambling.
That's the first big step.
It is. Acknowledging that these three concepts operate in distinct, non-overlapping arenas.
And here's where it gets really interesting, based on Lexicon's findings. When we look at the venue, we see this incredibly clear, almost surgical split.
Right.
In the stock market, you have investing and you have speculation. But, and this is the key part, you never gamble. You just can't.
You cannot.
But then if we shift over to prediction markets, let's say, contracts on political outcomes or economic data,
The landscape flips entirely.
here you have speculation and you have gambling, but you never invest.
That's the core insight. And it's shocking because we're all taught that investing and gambling are two sides of the same coin.
They feel like neighbors in our minds.
They want to be close, but the research proves, based on legal and economic definitions, they are never neighbors. They operate in parallel universes.
And the implication of that is just monumental.
It is.
It means that any legal brief or academic paper that's looking for a unified, workable principle to distinguish investing from gambling,
It's fundamentally flawed.
they're looking for a unicorn. It doesn't exist because they're never the same place to begin with. The whole search is centuries of wasted effort.
And that lack of distinction, that willingness to just let the word gambling be used as a moral stick, it's pervasive, even at the highest levels.
Oh, absolutely. I mean, take the academic world. There's this extremely influential finance article, cited over 1,000 times, titled, Who Gambles in the Stock Market?
That title just illustrates the problem perfectly. You're superimposing a moral judgment onto a legal definition from the get-go.
You're biasing the discussion.
Completely. Instead of asking when does rational speculation become excessive speculation, they ask this loaded moralistic question that frankly undermines their own research.
And that misunderstanding just bleeds into the legal world. We've seen an upcoming article, Betting on Everything, which says its aim is to find a workable principle to distinguish investing from gambling.
I mean, they're trying to find a common denominator between two concepts that don't share any space. Investing is about ownership, return on capital. Gambling is about state prohibition and a lack of economic utility.
It's brief that we've been mixing up legal and moral issues for way too long.
And it gets even worse when you look at the popular press.
Oh, the clickbait headlines.
They love it. Look at a recent Fortune article about prediction markets. The headline asked, are sports prediction markets betting or investing?
Okay, that sounds like a fascinating debate.
But that's not what the lawsuits were about at all. When Lexicon Labs actually reviewed the complaints, the legal question wasn't about definitions.
So what was it about?
It was the classic and frankly kind of boring regulatory question. Does the Federal Commodity Exchange Act preempt state gaming laws?
A federal versus state jurisdiction fight.
Exactly. But they framed it as a sexy investing versus gambling battle to get clicks.
That's just perfect journalistic misdirection. They knew the real issue was complex, but they went with the emotionally charged, misleading trap.
And we see it again and again. Take The Economist. They ran a piece called Gambling or Investing. In America, the line is increasingly blurred.
Okay.
And they talk about institutional investors who might want to place binary bets on these platforms. But just think about the language error there.
Institutional investors and binary bets.
They don't belong in the same sentence. Institutions have strict compliance rules, fiduciary duties. If these bets are deemed gambling contracts, it could expose them to massive regulatory and reputational risk.
Not to mention state-level prohibition.
Of course.
So the experts framing the conversation are perpetually looking for this invisible line that the research says doesn't exist. So what should we be focusing on? What are the real workable principles?
Well, if we can just leave that century-old baggage aside and start fresh, the right separation is found by focusing on the boundaries that actually exist inside these two markets.
Okay, let's start with the stock market. If the line isn't between investing and gambling, the true workable principle is separating investing from speculation. What does that actually look like?
The research identifies three key factors. The first is the valuation of a cash flow generating asset.
Meaning?
Investment has to be grounded in an analysis of what the asset, the stock, is going to produce in real dollars over time. Speculation is just divorced from that. It's focused purely on what the next person will pay for it.
Price movement. Okay, what's the second factor?
The desired margin of safety. This is a crucial distinction.
Right, and what is that exactly, the margin of safety?
It's the difference between your calculated intrinsic value of the company and the price you actually pay. So if you think a company is worth $100, but you only pay $60.
That $40 difference is your cushion.
It's your margin of safety. It protects you against miscalculation, bad luck, market volatility. A speculator doesn't have that. They assume the asset's value is just whatever the market says it is moment to moment.
And the third factor is simply the price you pay.
Exactly. Even a fantastic company, if you buy it at a reckless price, transforms the operation from an investment into a speculation. These three things, valuation, margin, and price, that's the true actionable line of separation.
Okay, so let's shift to prediction markets now. We said the line there is between speculation and gambling. So what's the workable principle in that world?
There, the distinction is based purely on economic purpose.
Economic purpose.
Right. Contracts that serve the public interest, like, say, providing a genuine hedging utility or contributing to price discovery, they should be allowed. That's regulated speculation.
Can you give us an example of that hedging utility?
Sure. Think about a company that relies heavily on, a political outcome. An energy company wanting to hedge against a regulatory change.
Or a currency trader hedging against an election result.
Perfect example. If the contract provides a productive way to manage a real-world, non-gaming risk, it has utility. Gambling, on the other hand, just creates risk for amusement or profit without any constructive economic output.
And when speculation becomes excessive, offering no public benefit.
That's when the law steps in and calls it illegal gambling.
So if we connect this to the bigger picture, our failure to get these definitions right means we're constantly fighting shadows.
Yes. We're trying to regulate morality instead of regulating economic utility and asset valuation. We really do need to leave that century-old baggage aside and just start fresh.
And the implication is so clear. Unless we fix the language, we can't fix finance. The whole regulatory structure is suffering because we use a moralistic word, gambling, to describe what is really an economic failure, excessive speculation.
It's a huge problem.
So we've been deep diving into the semantics here, but let's leave you with one final, kind of unexpected challenge to common financial wisdom that this research unearthed.
This one is really powerful.
The concept of value investing itself is presented as a myth that does more harm than good.
It really is a powerful finding. If you define investing as buying something for less than it's actually worth, following the 3 principles we just discussed,
Then all investing is value investing.
By definition.
by definition. The research suggests that figures like Ben Graham, who we call the father of value investing, or Warren Buffett, they were just practicing investing, period.
Applying the qualifier value creates this false silo. It implies there's an acceptable alternative, like non-value investing,
Which would just be buying something for more than it's worth.
which is speculation.
It's speculation, not investing. The term value investor is just redundant baggage. It creates these artificial divisions and encourages people to think there are multiple valid ways to invest when really there's only one sound path.
Which raises an important question for you to think about. If value investing, a cornerstone of financial culture, is just a myth, what widely accepted financial term needs the deepest dive next? Something for you to mull over.